Hello guys, welcome to another e-learning series from Gigsaw. Now in this video series we want to introduce our learners to the forex market. We'd like you to fully understand the concept of forex trading and how you can be a part of the forex trading economy. Now in this series we aim to go from the basics and just give you an understanding of what it entails. Now, Forex. What is Forex? Now, Forex or foreign exchange refers to the global channel through which traders, investors, banks, and financial institutions trade currency pairs. Currencies are traded simultaneously as pairs on the Forex market. For example, you have the Euro USD, which is a combination of the Euro and the USD. These are two currencies fused together and called a pair, a currency pair, and traded with one single price. The price is gotten from the Euro value divided by the USD value. The Euro is in front, so it will be divided by the USD value. That gives you a single value, and that's the value of the Euro USD. Now, Forex and you. The internet has created endless possibilities for the Forex economy. These days, anyone with a computer or a smartphone with internet access can trade currency pairs, and the earners are not limited to traders alone. You can even make a lot more money providing services to traders, like creating software tools to reduce their workload, or providing signals, or creating forex trading platforms on your own and leasing them commercially to brokers and financial institutions. Now, a currency pair, for example, I just explained this concept, but I'm going to go over it again. A currency pair, for example, Euro USD. On one side you have the Euro, on the other side you have the USD. Now, pairs are matched up and given a value drawn from the comparison of the two of them. Euro USD value would be how many USDs it will take to buy a euro. In other words, it is the euro converted to USD. So price of 1.2185 means 1 euro is equal to 1.2185 USD, which is euro divided by USD. That's also the same thing. Now, matching up two currencies in this nature results in an asset called a currency pair. A currency pair can be bought or sold depending on which direction you expect the market to go. Now, if you expect the value of the euro to increase, for example, you just watch the news on Bloomberg and the euro economy is booming, the unemployment rate has dropped, and a lot of other factors are really positive, and you believe that yes, the euro is going up, and then you watch the news for America and the unemployment rate has increased and a lot of problems the US economy is facing, and then you say, oh, the USD is about to go down. So in this case, you will buy the Euro USD, because when the value of the euro increases and the value of the USD decreases or remains the same, their mutual price will go up. So if euro used to be 1.2185 USD to 1 euro, it's about to become 1.3 or 1.4, which means the value of the euro USD is going up. But if you watch the news and it was negative for the USD and it was negative for the euro and positive for the USD, then you have to sell the euro USD because the USD value is going up and the euro value is falling. Now, pricing is how you buy or sell a currency pair. Now, one thing I made a mistake with for the euro USD, if you believe the USD is going up, you have to sell the currency pair. Selling means you believe the market is going down, so you can profit from the market going down by selling the pair. Now, the ask and the bid prices. Two prices are shown on every pair, and the distance between those two prices is the spread. You have the ask and you have the bid price. The ask price is the price where you buy at. If you're going to buy the Euro USD, the ask is what you pay. If you're going to sell the Euro USD, the bid is what you pay. Now, every pair has two prices, the ask price and the bid price. The ask is the price a pair is bought at, and the bid is the price a pair is sold at. And the difference between the two prices is the spread. The spread is the commission charged by the people fulfilling your transactions. For example, the broker. That's how the broker makes their profit, from the spread that they charge, which is usually very, very small, like $1 compared to you trading a lot size that's worth about $10,000. So they charge about $1 from it. So it's really small. Now, some brokers also charge commission after spread. Now, this is done by ECN brokers, because ECN brokers have extremely low spread. Sometimes they even offer zero spread. So they have to make their money from the commission that they charge from their traders. Now, in the case of the Euro USD on the left, the ask is 1.16055 and the bid is 1.16033. The spread in this case is 2.2 pips, which is 22 points. Now, the value of 2.2 pips can be $1, it can be $2. It depends on the size of the trade you're opening. We'll look at this much later, but just have that in mind. Now, the concept of pips and points. Now, a pip is the smallest unit of measurement when you're trading. When somebody wants to say they made profit, they usually say, oh, I made 10 pips profit, or I made 20 pips profit, or I made 50 pips profit. And the value of the pip varies on currency pairs. For Euro USD, a pip is 0.0001. And for USD JPY, it is 0.01. And for GBP USD, it is same as Euro USD. Now, points, on the other hand, is the smallest value on any pair. The smallest value. Now, for Euro USD pricing, you can see you have 1.16055. Now, the smallest value, the smallest movement that can happen on this ask price is 1.1055 to 1.1056. That is 0.00001. That's the smallest value on that price, in that pricing. That's the point value. Point value is mostly used when writing programs for the market, but most traders don't use points to measure their profit. They usually use pips. So points is more for programmers. Now, progress is man's ability to complicate simplicity. This is a quote by Michael James Watson. Please go back, go forward. If you have any questions, let me know. I'll answer them as soon as possible. See you in the next video.